Hey everybody, this is Chuck Marone with Strong Towns. Beautiful spring morning here in central Minnesota. Actually, we're getting some snow melt this week, so we'll see how it goes. Today we're going to talk commercial real estate. I had done a prior video talking about the way we finance homes during the Great Depression. Short-term loans with balloon payments, interest-only kind of things. And I said that was important to understand how commercial real estate is financed today. Commercial real estate, and this can be anything from your office building to your strip mall, your big box store, malls. It also includes apartment buildings and that type of thing. Those are all housed under this idea of commercial real estate. Commercial real estate, we did not create during the Great Depression this secondary market for it. During the Great Depression, we said we're going to have residential real estate no longer be a local product. We're going to make it a national product. We're going to use the power of the federal government to extend payments out over longer periods of time, lower interest rates, ultimately lower down payments. We're going to do a whole bunch of things to make housing kind of a long-term financial investment. So you would have, in a sense, patient capital backed by the federal government. You know, this was all basically insured. We took the responsibility off of local banks and put it on the federal government to have these longer term products, more stability in that market. Commercial real estate doesn't function that way. Commercial real estate is still dominated. There are some longer term products you can get, but for the most part, every commercial real estate transaction involves a short-term note, something that would be 3 years, 5 years, 7 years, with a balloon on payment at the end. And the balloon payment would essentially say, we're going to roll this loan over and refinance it, whatever is owed on the principal, that will be rolled over and we'll just keep going. The way you make money in commercial real estate is through leverage. Today, I'm not saying this is the way it's always been. Today, the way you make money in commercial real estate is through leverage. You borrow and borrow a lot of money. And the more of other people's money you can play with, the more you can, the more projects you can do, the more investment you can make, the more you can pay for property, right? If you are an investor, if you are a holder of commercial real estate, the idea that people can borrow more and more money has been great for you because it's allowed a whole bunch of competitors, a whole bunch of capital to flow into your holdings. I'm going to give the one housing related implication of this today. The way you value commercial real estate is not the way you value residential real estate. When we do comps on residential real estate, we'll go in and we'll say, okay, in this neighborhood, a similar size home with a similar number of bedrooms and bathrooms sold for this much. Yeah, but this one's got granite countertops and this one's got a, indoor pool. I don't know. Like you got your amenities. They vary on price, right? And we argue over that and you get appraisals. But you're coming in and you're looking at the quality of the product and what comparable properties sold for. That's how we do residential real estate. The way we do commercial real estate is how much money can you make off this property? You could have the junkiest property in the best location, and it's going to be worth a ton because there's all kinds of foot traffic, there's all kinds of sales, there's all kinds of stuff going on right in that place. You could have the most beautiful, beautiful building, the most luxurious thing in a horrible location, and it's not going to be worth anything because you can't sell anything out of it because there's no buyers, there's no purchasers, there's no consumers there. So commercial real estate is done based on rents. All right. Let's say you build your commercial building. Let's say you go build an apartment building. And the apartment building you're planning on, I'm just going to use just for rough sense so we can have this conversation this way. I'm going to say you're planning on $1,000 a month rent for each unit that you build. You go out, you get your pro forma, you get the money from the bank, you borrow, you go out and you build it, and you put it up $1,000 a month. And that's what you need to get to make this project work. And nobody comes and rents from you. The market's like, we can't do that here. I won't pay that. Nobody will pay that. And the buildings sit empty. In a classic kind of scenario in a economic supply and demand kind of thing, the suggestion would be that the price should then fall, right? We should lower the price 800, 700, 600, 500. It should keep going down until people actually come and rent it. You have an assumed motive to rent that building, but not so fast. You've got it financed to the hilt, right? You've got very little equity. You've got this loan, this loan, this loan, and you've got a balloon payment that's coming due in 3 years. If you say lower your rent to $500 a month, so cut your rent in half, now all of a sudden your building is worth half as much as it was when you built it. It's worth half as much. All right, follow me now. Your building comes up for renewal. That balloon payment comes due. And the bank goes out to try to appraise your building. Say, here's how much we'll lend you. Here's how much your building's worth. Here's how much we'll lend you. And they find that the building is worth half as much as what everybody originally thought it was, because the rents are half as much. What will the bank do? Well, the bank will say, we'll lend you half as much as we did before. Now you need to give us the rest in cash right now because your balloon payment's due. That's on you. That's not on us. Commercial real estate, you can't do that. You can't make that work. You can't make that happen. You'd have to essentially give up the property. The bank would foreclose on you. You would default on your balloon payment. And so what happens? See where this is going? What you do is you keep the rent at $1,000 a month and you let the units sit empty. There'll be someone who will rent at $1,000 a month, maybe 20% of your units rent, maybe it's 40%, maybe it's 60%. You just keep the rent really high and you hope that the market comes to you. You hope that at some point people fill back in the market and it winds up willing to pay you this amount. You can do this kind of indefinitely when interest rates are near zero. When the cost of capital is really low, you're not getting punished month after month after month for holding that loan. But when interest rates start to go up, now you can extend and pretend, as they call it in the business. You can pretend that someday someone will pay $1,000 a month rent for this, but you're going to get punishing interest rate payments every month. You go from an interest rate environment where you're paying 1%, 1.5% on capital to one where you're paying 5%, 6% on capital. You are bleeding money now. And bleeding money it forces change, right? It forces people to make changes in their business plans. There is a belief in financial circles that the longer interest rates stay high like this, the more inventory is going to come on the market, the more, in a sense, zombie inventory or ghost inventory that's being held back is going to come onto the markets. The YIMBY people hate that conversation because they're all about build, 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 build. There's not enough housing. There's not enough inventory. The financial people have a completely different view. The financial people are like, I'm nervous about building because there's a lot of zombie inventory out there that is stuck in this kind of like financial purgatory. It's not being released on the market because of interest rates. We will see very, very soon who is correct.